Hi, my name is Adam Sussman, Director of Research at TABB Group, joined today by Alan Hill, CFO at JonesTrading. Welcome, Alan.
Thank you.
Here to talk about block trading.
Yes.
What else? So, Alan, based on interviews that TABB Group did with 108 long-only asset managers towards the tail end of last year, I was a bit surprised we actually saw a pickup in the percentage of trading that these institutions are doing in block size.
Yeah.
So tell me, at a time when commission wallets are down, volume's down, I mean, what's your explanation for why we would see this uptick?
Yeah, and I would echo that uptick. We certainly saw that in our business last year. Last year was a very good year for Jones. I think if you look back 5 years, the market had 12 billion shares a day was trading, and now maybe this past year maybe it was about 6.1 billion shares a day on average. Some days there's 5 billion shares.
Right.
Half the volume's gone away in the market. I think the value of the block has increased exponentially over that time period. If you're a trader on a desk and your portfolio manager says you need to buy a million shares of something, a small or mid-cap stock, obviously where we'd specialize,
right,
something that trades 100, 200,000 shares a day, and you have to buy 5-6 days worth of volume, being able to get a sizable chunk of that trade done in one block is the most efficient way to get things done. And I think people have realized the efficiency of the block more as volumes have gone down. Certainly.
So let me get this right. So
yeah.
You guys are sitting around the offices at JonesTrading, and when you see volumes drop, you're kind of like, you're quietly cheering?
Very quietly cheering, perhaps. I don't know if I'd wanted to go any lower than where it is now, but
right.
Yeah, certainly I think a lot of the volume was false volume maybe, or electronic volume generated by people that weren't necessarily working on behalf of institutions, like our only clients are institutional clients. So I think as that volume has gone away, it's harder for people to get things done, and that's why they're calling us. So
it's a good explanation for kind of the cyclical uptick that we've seen over the last year. Of course, there's also been a lot of talk about, structurally, have the markets changed so much that, that the way of trading, block trading is, is kind of on its way out. Obviously, you would we would disagree. But I mean, are you concerned that with this new generation of traders so used to I don't know, point and click video games that the art of block trading is going to be lost?
With every challenge, there's probably an opportunity. I would say one of the things with the electronification of the markets, buy-side clients they have a hard time understanding the market now too, and it's volume is so disintermediated, it might be harder for them. If you find it's point and click and you can get things done quickly, but if you don't know where liquidity is, it's very hard to get something done still. So we'd say, from our perspective, yes, obviously the electronification of markets has increased and keeps increasing, but as volume gets scattered in 50 places or 100 places versus 2, being able to find real liquidity, institutional liquidity on an agency basis where your counterparty is going to stand up for size in the market is actually getting more valuable, maybe even in the face of the electronics.
So you're not only quietly cheering when volumes are down, but like even more fragmentation might even be good for you too.
I don't know about that, but yeah, it may be. It may be.
Now, what about the way in which the buy side is measuring its executions? Sometimes we hear that it's the benchmark that's driving the behavior rather than and that if it's an inappropriate benchmark, it might actually be leading to suboptimal decisions. I mean, are you guys running up against that where people are like, I'd like to do that, but it'll make me look bad?
Yeah, I think we see quite a bit of that, and obviously it's a challenge. It's a behavioral challenge, a marketing challenge for us when we're speaking to clients. We'd sit there and say, if someone at your firm wants to buy this stock or sell this stock, they think the stock, if it's a buy, they think it's going up 20% in the next year. Why would you then sit there and say, oh, I'm afraid to get into that because I'm being measured against the VWAP, and I only want to be 5% of the volume for the day, and fine, it might take me 20 days to get into something or a month, and clearly then there's market exposure with the length of time. But we would say, well, why would you expose yourself to that length of risk by getting into something in a real small way just because you're worried about meeting the VWAP or not meeting the VWAP? The much greater risk, you know, is not getting something done. Whereas if we say, hey, you can get into this thing, we have 500,000 shares, so you don't have to be buying 20,000 shares a day, you can get into it in one go. I think that is a much better thing that you can measure with. You're done on the trade and your firm is better off because, you know, someone at your firm, your portfolio manager, whomever it is, thinks that stock's going up, so you should get into it sooner rather than later.
And do you think that the buy side is gaining any or making any traction in terms of moving away from that benchmark?
In certain cases, I think the market has struggled, it seems to me, with trying to find what the right benchmark is, and maybe over the last few years the less scientific models like implementation shortfall is going away a little bit, but VWAP's easy to measure, right? And it's very easy for someone to come in and say, hey, you missed the VWAP by X.
Right.
And people seem to be migrating towards what's simpler, which may not be better.
Right. Excellent. Well, I think we'll wrap it up there. Thank you, Alan, for coming in today.
Thank you.
CFO at JonesTrading. Again, Adam Sussman, Director of Research at TABB Group. Thanks.
Thank you.